If you don't hear it from us or from people that talk the way we do, you're never going to be exposed to this idea. You're only ever going to hear the virtues of the 401k and how is the primary way to grow wealth is through this tax qualified account.
What is under attack here is the strategy of buying term and investing the difference. That is under attack, not term life insurance.
The business has to make a profit to stay in business. We will make a profit on the one person who dies statistically in this pool, and the other 99, we keep 100% of their premium.
Nobody buys a term policy with the expectation of dying in that term. It's more expensive because it is 100% going to pay a death benefit. It is 100% going to have a future cash flow to your family or beneficiaries.
What if they knew with 100% certainty you would total the car? Do you think your premiums would increase or decrease?
We can close that gap with convertible term insurance, and it's just what it sounds like. You can take that term insurance and you can convert into whole life insurance policies that we can then even still design to be used as the infinite banking. It's extremely important because it's a way that we can cover our entire human life value at a price we can afford. Hey, welcome back for another episode. Hans, we're wearing the same clothes. So for those that pay attention then on YouTube, we're recording back to back here. I'm just going to point that out because it always gets called out.
Yeah, I've never been a big YouTube watcher of anything really. I listen to a lot of podcasts, but always on the Apple app or Spotify. So I never really pay attention to YouTube, but turns out last week we had our biggest episode as far as views. And when I say last week, by the time this comes out, that would actually be the part 1 of the No Method to Boomer Madness. It's a different name under YouTube, but it's the first of our 2-parter about kind of unveiling the typical method of the CFP. And we had, I want to say like 20x our typical viewership within a week on that one. And I think I know why. It's because the title references boomers, retirement, and the Ponzi scheme of Social Security. And there is something about saying the word boomer in any light other than exalting them that brings them out of the woodwork to just like the comment section keyboard warriors. And it's really interesting because one of the first comments was how we're making these crazy generalizations. And okay, yeah, you got us. When you're talking about a generation, the largest one in history, in fact, you're talking about tens and tens of millions of people. So inherently, any observation of a generation or the fact that even generations have labels, even why do you pick the labels you do? You know, like the whole thing is, it's very, very loose descriptions of a massive group of people that have no relation other than the year they were born. So it's already a pretty kind of a silly category to begin with, but it does, the fact that they exist and the fact that they are different and the fact that people can describe things about them, it's like a stereotype, you know, like stereotype is for a reason, even though
It doesn't fit everybody.
Right. Yeah. It's like, okay, you know, it's like I'm going to walk into a 7-Eleven. There might not be an Indian guy working there. But, you know, like I know who's going to be working there or Pakistani, whatever. Like stereotypes have a basis to them. Generational discussions and breakdowns have and tendencies, trends, etc. Like they just exist and we all know it. And so what you don't need to do if you're a boomer that listened to that episode and the way we talked about that generation is you don't need to jump in on the comments.
Yes, you do.
Okay, we appreciate comments. It actually helps as you're chastising us for being, you know, like lazy little millennials, whatever, etc. It actually does help with engagement. So we do appreciate that. But besides the algorithm, you don't need to say, you know, boomers who did it differently. You are a boomer who did it differently. Like, of course, we're talking what 50, 70 million people. Of course, there's no, like, not everyone is the same here. You know, my parents are exact opposite of everything we talked about. My in-laws are the same way. Like there's a lot of fantastic parents that boomers. There's a lot that really set up the next generation, but as a whole generation handed wealth and handed like the perfect environment, like we talked about, to just have skyrocketing prosperity. And it's going to be the first generation that does not leave the next generation better off than themselves. I believe, I think in history of like, at least as far as like American economic history and how it's been tracked, it's the only generation where we really consistently hear the idea of, well, I'm not going to leave anything behind. I wouldn't say we even consistently hear this, but when we hear it more often than not, it is from this generation that, you know, they need to pull themselves up by the bootstraps. it's just the generalizations are accurate, even if they're not accurate to you and to everyone else. And so we're going to keep hammering at it because it does bring up engagement. If we're going to get a 20x increase in our engagement just because boomers can't take anyone saying something negative about their generation, which there's a lot to say there. And it's pretty unanimous consensus of everyone else, but whatever.
Are you into video games?
No.
Well, but you're a millennial. All you want to do is sit around and play video games.
Yeah, I do not play any video games at all.
Weird. Like, so that you mean that generalization doesn't fit you?
Right. I'm not a lazy millennial. I got to hop on. I got to hop on the comment sections and just rip it apart.
You play video games all day. You're such a liar.
Yeah. And it's healthy to be able to hear criticism, even if it doesn't reflect you. Just like, okay, maybe we should take this to heart. Okay, maybe this doesn't all apply to me, but I do have this idea of thinking that I'm going to burn my kids' inheritance. I'm just going to burn it on cruises, like this idea of like going on cruises and just being indulgent. It's a weird anomaly in history that is going to be viewed as just this horrifically selfish, self-indulgent generation as a whole. Of course, not all of you.
That just like gave me a thought about a discussion I just had. If I can take a moment, I just had a discussion with somebody, and I'm not going to get into big details because I don't want to make it, well, it'll be obvious to that person, but of that boomer generation, somebody in their 70s has a pile of money that they accumulated in the traditional way. And this just goes back to what we always talk about with the typical financial planning, and they're trying to figure out what to do with it. It fit the mold exactly what we talk about. No whole life insurance involved because that was not marketed. It was marketed as a bad place to keep your money. So very generally speaking, not a lot of that generation has a lot of whole life insurance. And the trouble right now is to figure out how to move it into a better vehicle to leave to the next generation. So they're breaking that mold, which I admire, in the most tax efficient way, to take it out of this government vehicle, like a 401k or 403b or whatever that vehicle was. And they're looking at like, well, do I get this into a Roth IRA or do I get this into some other thing? And they're facing the exact scenario we always talk about that shows the power of whole life insurance. And one of those things is, how can we efficiently transfer wealth and not have to look at the same pile of money as our source of income, our source of eating, our source of enjoying ourselves in our latter years, and our source of leaving an inheritance to our family? Because most people, and most people, even a lot of people in that generation even do want to leave something, but they haven't really planned for it until late in the game. And now they've got one accumulated pile of money to try to do all those things. So the conversation was actually fascinating because we've talked about it so many times, and it's like a real life scenario of somebody trying to figure out how to do these things in an efficient manner. Whereas if they like thought, if this paradigm that we're always presenting existed for that person 40 years ago, they would maybe still have a pile for a cool, like you got a 401k, I have a 401k, but I also have a lot of this. So when it comes time to take distributions, I can take distributions from my 401k all the way down to zero and not have to figure out how to leave my family something because I've got this income tax-free transfer of wealth mechanism in whole life insurance to do that job. So it was like, actually that conversation, I had that conversation this morning. It was awesome. And it fits like, sort of what you're talking about with that boomer generation, the generalities and stuff. Like, here's a guy who's really wants to do the right thing, but didn't have the right context in the youth when he was earning money to figure out how to do it the best way. Yeah, reframe your thinking, man, because it happens. Like it is the perfect example of somebody that's trying to do all things with one pile of money.
Yep. That's the permission to spend we talk about. The pressure you're putting on that pile of money. And when you're working and accumulating or you're earning income, that the purpose as far as the protection component goes, set aside the living benefits for a moment of whole life insurance. But on the protection side, the death benefit side, what you are insuring is that income. But once you stop working, there's no longer income, but you want to replace the assets that you have to ensure that the estate in its entirety is passed on to your children, not spent down or not greatly reduced because you had to live off of that for an unknown amount of time. And so you kind of switch from protecting income to protecting your assets. And it's a great place to be, like you said, when you can spend that down and not have to worry about that also being your children's inheritance.
Yeah, we often just ask people, like, if you had easy number $1 million when you're retired, would you be afraid to spend all of it if you knew that upon your death it was going to be completely replaced tax-free, income tax-free to your wife, your kids, whoever, husband, wife, kids, whoever you're leaving it to, whatever beneficiary that is? And I've never had somebody say, yes, I'd still be afraid to spend the money.
We'll do a whole episode on this because it's such a fallacious idea, but buy term and invest the difference. We hear that over and over and over. It doesn't happen. It doesn't work. It is like the epitome of this bad strategy we talk about. A lot of the stuff we talk about and we bash on 401ks and stuff because someone needs to do it. Because if you don't hear it from us or from people that talk the way we do, you're never going to be exposed to this idea. You're only ever going to hear the virtues of the 401k and how it's the primary way to grow wealth is through this tax qualified account, which again, it's just a tax benefit. Like we want tax benefits, but it's not like something to be praised. It's just a tax account. It just gets different tax treatment in IRS code. So we talk about it pretty aggressively, even though like if someone comes to us and says I'm doing a 401k because, or you're doing a 401k because you're a pilot and they have this 17% match, right? So it's like we're not dogmatic to the point that we're like, you do this or nothing else, and we don't understand why you're doing what you're doing. But we do talk about it pretty aggressively because you need to hear it and you need to hear this other side.
It sort of forces you to defend it. And that's why even though like I have a 401k, I actively have a 401k, and I can see the virtue. Like I can see that the S&P index has, if you just put your money into that, has consistently grown if you look at the long term. And I don't think it's like anything great. I don't think it's the miraculous thing that they teach. I actually don't think that at all. I'm not an overly big fan, but I still have one. But by us attacking it the way we do, we force you to defend it, and we force you to actually think about the merits of the plan and if it actually is aligned with your goals. And if it is, do it. Cool. But I've never had somebody force me into that position until I learned infinite banking and started thinking about money in a different way.
Yeah, like we want you to start thinking about this. That's why we are aggressive with this. But I will say that there is the buy term and invest the difference mentality. That is objectively terrible advice. Like we're not just trying to get you to think about it. Should you do buy term and invest the difference, or should you? No, you should not do that. That's terrible, terrible financial strategy with no exception. Because what that does is one, it presumes that you're gonna, like the insurance component of it, you are intentionally cutting off at the point at which you switch from that income protection to asset protection. Like your need for protection doesn't go away once you're not producing income. Your need for homeowners insurance doesn't go away once you've paid off your house, right? You don't pay the car loan off over 5 years and then cancel your car insurance. Like it just, at one point in the insurance and life insurance, you are protecting the asset that is your income because you are alive. It's just this future payout. But what if you don't make it there, right? You want your family to have the income you would have earned otherwise. That's the income side of the protection. But then what happens when you retire? You're no longer making income. Clearly, there's a reason for it, but beyond that, and that's that permission to spend. And so what you're doing is all these boomers that don't have any insurance, it's because if they bought into this idea of buy term and invest the difference, they've all outlived it, as 98, 99% of people do. They outlive term. It's the most profitable product for an insurance company because there's nothing owed to the policyholder while they're alive. It's just renting insurance. And 1-ish% of policies ever pay out. So 99% of those benefit, the premium, they're just keeping it because you outlive it and now you have nothing to show for it, and you probably can't get insurance now, or it'd be very expensive to do so.
It is priced in such a way that the plan is for you to outlive it. If I'm 43 years old, if I try to get a 30 or 40-year term, it's egregiously expensive. Because there are some companies that have like a 40-year out there, they do exist. If I were to take term insurance into my 80s, it is so expensive because the company thinks I'm going to die. Actuarially, I'm going to die in that term. So they're going to price it way high. So all these term policies expire before you're most likely to die, when you most would want that death benefit. And the other thing, I mean, I want to add, like, we're not anti-term. As a matter of fact, I like term insurance. I think term insurance is extremely important to cover human life value. Term policies do have their place in your financial life because most of us can't afford human life value and whole life insurance. So they have their place. We like term insurance. What is under attack here is the strategy of buying term and investing the difference. That is under attack, not term life insurance. So just please don't misunderstand that if you're new to listening.
Yeah, and I think that right now we're going to pivot from what we plan to talk about because clearly, like, I think we need more on this.
I just had a segue too. That's awesome. Yeah, let's do it. Whatever you want to do. But I had a perfect segue in mind to go what we were talking to, but we'll talk about that in another episode. Whatever.
I think this needs to be discussed more. And what an article I'm writing right now. One thing I like to do is Brian likes to do the videos. He likes to do that kind of content. I like to write. And so when we have these FAQs, things that are every client has the same 5 to 10 questions that come up when you're exposed to this idea. The same questions always come up, and that's what we try to hit here. I like to try to hit those in writing because I'm better at composing my thoughts, on a working, 3 or 4 page paper over time. And as I have more ideas, I go, so like at any time, if I open the Word app on my computer right now, I have 4 different articles up, and I slowly over time just like to add to those. So one of them I'm working on right now is called Create an Estate and Invest the Difference. So this idea of buy term and invest the difference, that requires you to do several things. That requires you to price out whole life insurance for an amount of death benefit, write that number down, shop around to get term for the same amount of death benefit, calculate the difference. Then put that difference into the market. And that right there, already people are not doing that. They say they're doing it, but what they're actually doing is just saying, whole life is bad. I'm not going to look into it. I'm not going to learn about the living benefits. I'm not actually going to price out whole life insurance. I know I need $1 million of death benefit. I'm going to skip the whole life shopping at all. And I'm just going to buy a term policy for the $1 million death benefit. It's way cheaper. I know it's cheaper. And then as a strategy, I generally invest in the market. That's what people are actually doing. No one's actually pricing the two, taking the difference and investing it, and then getting that comparison.
I just want to jump in there. Depending on the order in which these episodes come out, I'm assuming that the last episode is where we talked about currents, which is displayed on your shirt. And we talked about saving that amount of money and how the normal behavioral pattern of an American is to spend the money that hits their checking account. So the first failure in what you said is they don't actually price shop. So they don't actually know the difference. And if they don't even know the difference and they haven't planned to use that to do the investment of the difference, what is going to first happen to that money?
It's going to be spent. It's going to be put in the checking account, and just some might get invested, but certainly not the difference.
Not the difference. And so there's 2 points of failure, like in the statement, buy term and invest the difference. One is the first 2 points of failure is they don't know the difference. The second point of failure is they're not going to invest it. Like they can't. Actually, it's impossible to invest the difference if you don't even know what it is. It's an unknown variable.
Yeah, and that starts with a conversation. And again, you go to whether it's your, name your financial entertainer who doesn't understand this product, or I think actually does, but doesn't sell it and therefore says it's the worst thing ever, right? So you go to that website, or you go to a CFP and they say, hey, here's an example. Look, I'm just going to pull this up. You could, $500,000 of whole life insurance would cost you $12,000, and then if you get the same thing with term, it's $1,200. Look at this crazy difference here. You really want to pay 10 times more for whole life insurance? We're not going to talk about the living benefits. We're not going to talk about tax-free growth. We're not going to talk about guaranteed compound interest. We're not going to talk about policy loans and accessible cash. None of that. It's the death benefit. Which one is cheaper? Well, yeah, this one is 10 times cheaper. Sure, I'll get that, right? And then, so you're not actually going to take that $10,800, whatever difference is, and go and invest that. You're just going to take the word of this financial entertainer for it, that, yeah, why would I buy the same product for one, 10 times more? I'm going to pay 1/10 the cost, and I have this term policy, and I'm just going to use the market for the rest. Now that's as far as it goes, as far as actually, we're not looking at my specific situation and my understanding of cash value, my understanding of the living benefits, et cetera. We're just saying, why pay 10 times when you could pay 1/10 for the same product? And not even mentioning that you can't even compare. It's not an apples to apples comparison, because you're not mentioning any of these other benefits. If that were the only case, if we were just trying to promote the idea of efficient death benefit protection and never mentioned any of these other variables that we're talking about all the time, the living benefits, I could see the argument that this is not an efficient place to put your cash. Now, the permanency of it is worth it. But again, without the cash value, without all these other features, it's hard to make the case for whole life insurance. I get that. But that's not the right comparison, because we're talking about rented benefit. Now, do you think that if more than 1% of people died during their term, it would be priced the same way? No. The reason it's cheaper, the reason it's 1/10 cheaper, whatever the number is because they know on average 1% of people, for every 100 people that have a term policy in the same age, health rating, et cetera, one of them is going to die during that term and pay out. The other 99, they're going to keep in 100% of the premium. If those numbers were different, do you think the prices would remain the same? No, they're pricing it because they know you're going to outlive it.
Every so many years, there's a mortality table that comes out, a standard commissioner's mortality table that all of the companies utilize that data to see what the metrics are for when people die based on all kinds of data. So they don't know that I'm going to die at 43, but they know that a certain number of people in my demographic are going to die at 43, right? In my current age. So they price that. Now, over time, as you look at American history, people have lived longer and longer. So those prices change. So every time a new mortality table comes out, they reprice all the companies will reprice their products based on the new mortality table. And then you have to look at all the metrics of when you start this policy and when it expires and where you fall on that table. And then the risk class that you come into, like, your lifestyle, your occupation, all that stuff is factored in. The actuarial analysis is so in depth and so accurate, not to a human being, but to a population. It's astounding how accurate it is. So when you take the policy out, they know that you're like 99% likely to outlive that policy.
Here's an example of when trusting the science is good. Because what is science? We've heard trust the science over and over the last 4 years, and it was all bullshit, right? That there's nothing that should have been trusted less than the COVID science. It was all made up. They admitted it was made up before. They pushed it anyways. They reaffirmed that it was made up afterwards in the recent COVID, after action report. Like, it was all horseshit from the start, and people still fell for it and said castigated you if you didn't, quote, trust the science. But here is science that is very reliable, because science is just a method. It's not like a philosophy. It's not a way of thinking. It's just a method. It's just the study of a theory and stress testing a theory over and over until you can confirm that the theory holds water, or you can disprove it, right? Now, we're talking hundreds and hundreds of years of actuarial science where these numbers reflect every time it comes out. They're very, very close. And like you said, they don't know that you're going to die in this 20-year term period, but they know that 1.4 of you are going to die this year that are into this. Like, you're stratified into these groups to which the scientific method is applied. If the scientific method was not working, and if quote the science here, the actuarial math was not working, these companies wouldn't have 140 plus years track record of doing this business profitably, because they know our term policy holders are going to outlive their policy to the tune of 99 out of 100. And therefore we can price it so cheap, because we will still make a profit. A business has to make a profit to stay in business. We will make a profit on the one person who dies statistically in this pool, and the other 99, we keep 100% of their premium, even though the one person who did die, their beneficiary got way more in death benefit than the policyholder put in as premium. That is true. But if 2, 3, 4 people in that pool started dying consistently, the mortality tables would reflect that very quickly, and they would price even quicker. And so at the end of it, when you outlive that, if you're in the 99, now, have you ever met a client who wants a payout on a term policy?
No, not a single person wants it. They're expecting to outlive it. They look at it as simply a protection of their death, to protect their income, or even if they're looking at it incorrectly. Like, we understand that it's a protection of your income and your human life value as an asset. But even a lot of people would just look at it as like they just think incorrectly, like, oh, it's just a death benefit, so my family's taken care of in the event of blah 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 blah, and that's why all the metrics are often incorrect on how to calculate that. But yeah, they expect to outlive it, and it's just like, hey, just in case I don't, I want to make sure that my wife, kids, or whomever is important to them gets something.
Yeah, they can pay off the mortgage, whatever.
Yeah, pay them more. We talked about that in the past, but nobody buys a term policy with the expectation of dying in that term.
Yeah, because what does that mean? That means you died early.
And there's also a reason that if you have an illness, let's say some sort of terminal illness or some sort of chronic illness that gives you a higher likelihood of death, the company won't issue a policy. You have to be medically underwritten for these unless it's group term and it's through an employer. So they already know, like, if you're likely to die in the term, you can't even get it.
I'm 3 or 4 years into my whole life policy, and I am very close to parity as far as dollars put in as premium and my total net cash value. I'm almost there in about 4 years. Took a little time. If you are 4 years into your term policy, what do you have to show for that right now? There's no such thing as cash value.
It literally is an expense. It's an expense.
Right. And that would be the perfect segue into what we want to talk about, which is what is cash value, which we'll do next. But the reason there's no cash value in a term policy is because there's no guaranteed future payout. There's no anchor point in the future from which to derive the net present value of that future payout. Because the payout is uncertain, it's almost a certainty that it's not going to pay out. So you get through this term, 99% of us are going to outlive it. So you took out a policy, let's say you took out a 20-year term policy this year at 44. What happens when you turn 64?
It drops off, it goes away.
And what do you get back from it?
Nothing. There are some products where you can get the premium back, but typically the standard term life insurance policy, you get nothing back.
Yeah. So you get nothing back, which means the company keeps 100% of it.
Something we talk about all the time when we talk about utilizing our policies for the infinite banking concept and getting your money to work is, what is that called when I just have an expense that I send cash out and get nothing on it? All that cash is gone from my life. So there's an opportunity cost of that. And since I'm 98 to 99% sure to outlive it, if that premium cost me $1,000 a year, I'm looking at $30,000 or $20,000 a year in that example that I've paid for premium that could have grown to something else. So let's look at that. If I just had it in an environment that grew at 4, 5, 6, whatever percent, use the S&P, and you want to have your magical 12% growth, like what would that $1,000 every year at that growth factor have done over the course of 20 years?
And what do we talk about in a recent episode? A cash flow sword. You just handed the insurance company this cash flow sword. That cash is never going to produce for you ever again. After 20 years, it was $20,000, whatever the example was. The company gets to keep that. And ironically, when you hear the critiques of online entertainers about whole life insurance and they misunderstand the idea of cash value, and this is something we'll cover in our cash value episode because it's the perfect analogy. It's the perfect example of not trying to understand a concept that is very fundamental and basic and easy to understand, but it's so often spouted as a criticism of what we're doing that it could only be intentional in my mind, an intentional misapplication of terms to redirect your audience to something else because it's such a simple idea to understand. But what they say is, well, when you die, the insurance company pays your beneficiary the death benefit, but they keep the cash value. We will get into the example in our next episode or whichever that might come out prior to this. But what is cash value? You'll understand when you listen to that episode why it's not like a gray area, like that is black and white. That's wrong. That's incorrect. That's a misunderstanding of terms that have definitions and exist and aren't ambiguous. That is just a straight up wrong approach. And ironically, when you outlive your term policy, you actually did. In fact, they do keep all the premium. You have nothing to show for it. It's bad math. It's bad intention, in my opinion, because it's such an easy concept to understand. We will, when you listen to our what is cash value episode, you will understand within one episode why that statement, when you die, they give the death benefit, but they hold on to the cash value. You will understand why that is erroneous. There's no other side of the coin here. There's no, you can't play devil's advocate and give benefit of the doubt because it's a completely incorrect statement. It doesn't make sense. It's illogical. And so it could only be bad intention why that is so commonly promulgated, because it's not hard. And you will understand, I promise you, in that episode.
Do you feel better?
No, I mean, I have a sword in my hand, dude. I like it. It makes me angry because I bought into it for so long. I bought into it. And when you're holding a sword, you're more energized. And it's like, I just, get a sword if you don't have a sword. It's awesome to have.
I need to get a sword,
dude. It's just like, it's invigorating. I love my wife so much because she got me a sword for Christmas, and that's the most badass thing ever. But now I feel a new level of energy and vigor when we're talking about this. And especially when we're talking about such a easy concept that is so misapplied that, I want to do that cash value episode. But I want to just say why that doesn't make sense, but we'll save it for that episode, I think, because it's such a pivotal point.
Let's save that. But I want to go back to buy term and invest the difference. And the pricing of that. So we talked about the fact that there's a couple things. One is, if you didn't buy term and invest the difference and you bought the whole life, you're going to get that cash value and you're going to get it in a guaranteed environment. So it can't go negative. It can't go down. So one of the fallacies of that is that if you just invest the difference, it's going to far exceed, whatever metric they're using whatever false metric they're using to compare it to. And the problem with that is it can go down in everything they're talking about. It might underperform what they're talking about. It can go backwards in what they're talking about. And so that's an important part of that, where that falls apart. But the other part is term insurance actually priced differently than whole life insurance? Why? Like you just told me that it's 1/10 the price if you looked at that policy. So you're saying you said cheaper, and I would argue that was the wrong word. More inexpensive is better. It is cheaper because it's a cheaper valued product because of all the reasons you're starting to get into. It's more inexpensive though. Let's use the expense because it's also a cheaper product in terms of value. But why is it more expensive if it's priced the same? Like that doesn't make any sense.
Yeah, because it's priced off of the exact same math as whole life. Now with whole life, they're saying we are going to, without exception, as long as a unilateral contract means you have one obligation and the rest is on them. You pay that premium, you keep the policy in force. They are going, without exception, to pay that death benefit out. It's a certainty that they're going to pay it. Whereas in the term policy for the same individual, it's a 1 in 100 chance they're going to pay it. And so they like those odds. I like those odds. I'm a gambler. I like those odds a lot.
But they're extending. So they're really just pricing you like we talked about. I said if I'm 43 and I could get a 40-year term, it would take me to 83 and it would be priced way higher. Why is it priced way higher? Because the likelihood of my death happening is it's more likely, right? It's not guaranteed. So unlike whole life insurance, it's not guaranteed, but it's more likely to happen. So they have to price that into the equation. Well, whole life or life insurance in general, whole life insurance is the only product. Maybe I should say permanent insurance, but a lot of those cannibalize. So let's just say whole life insurance for the sake of this argument is the only insurance that is guaranteeing an inevitability. Every other insurance, your fire insurance is protecting the if your house catches fire. Your flood insurance is if your house ever floods. Your car insurance is if you ever get into an accident. Your whole life insurance is when you die. It's a guaranteed thing. So they're actually pricing that term as if it's going out to age 100 and let's say whatever. I mean, they price it to age 121, although the life expectancy, I don't think anybody's made it to that point yet in America. So let's say they know you're going to die, actuarially speaking, by 107 is almost like the inevitability. So they're pricing it out as if it was a term that could go that far and they had to pay it and they knew you were going to die inside that term. So of course it's more expensive. It's covering the guaranteed event of your death. It's not more expensive because it's whole life insurance and it's ripping you off and they're keeping your cash value. It's more expensive because it is 100% going to pay a death benefit. It is 100% going to have a future cash flow to your family or beneficiaries.
And let's take car insurance. Let's just think in your head, ballpark, what your insurance premium is right now. And car insurance is priced in 6-month premium. So let's take your 6-month premium. Let's call it $500 a month for whatever. The numbers don't matter here. Let's say you're paying $500 a month for your family's couple cars for a 6-month premium. That's $3,000 over that 6 months is what you're paying in car insurance. Factored into that price and baked into the assumptions that how you got to that price is the chance that you total your car and they are on the hook to replace it entirely. I don't know what that number is, but let's just use comparable language here. Let's say that 1 out of 100 policyholders totals their car in a 6-month period, right? Making up a number here, but that's the term side of it. What if they knew when you bought that car insurance policy with 100% certainty you would total the car? Do you think your premiums would increase or decrease or stay the same with that assumption?
Well, not even a 100% assumption, but why the same? A great example of that is if I insure my 16-year-old driving a Corvette, or I insure me with no history of accidents at 43 driving the exact same Corvette, who has a higher likelihood, not even 100%, which one has a higher likelihood of crashing that Corvette? Why is insurance so expensive for somebody under 25? Car insurance. If we don't even have to look at the 100%, we can actually look at the actual data we all experience. Like, finally, my insurance dropped when I was 25. It's because you were way more likely in those first 10 years of driving to crash. And they priced it in. They priced that into the model. But if you were guaranteed to crash the car, they would have to charge you a rate that was probably going to bring more money to the company than the car was worth. It'd be way higher.
Bringing that analogy back to life insurance, like when you sell your car and you cancel your insurance policy on that car, or you buy a new one and you scrap the old one, what do you have to show for the insurance you got? Nothing, right? It was all premium paid out. There was a chance had you totaled it, they would pay for the cost of the car. And that's why you have the insurance. I mean, you have to have it. So that's part of why you have it. But you want the car insurance because if you total the car, you want it to be replaced. But when you sell the car and you cancel the insurance policy, you have nothing to show for it. If you had totaled the car, you would have gotten a brand new car. That's why you have the policy. In life, that is a term policy. You hope you don't total your car. You hope you don't die early. So you pay your insurance premiums. And when you outlive that term, when you sell the car, the policy goes away and you have nothing to show for it. Thank God you didn't die during that period. We're all happy to outlive our term policies. That means we live longer than expected, or not than expected, longer than we plan for with the term of this policy. But in life, you will total your car. You will total your life.
Why don't any insurance agents or financial planners, for that matter, ever say like, hey, let's price shop the most expensive, the highest coverage we can have on this car and the lowest coverage we can have on this car within legal limits and invest the difference. Why do they all tell you that you should probably take it to the max level and have the highest liabilities? And some do, some don't. There's a lot of bad advice out there, but why don't they ever look at the highest and cheapest when it comes to home insurance and car insurance, and like, what's the least amount I can insure my home for, and what's the most amount that anybody will provide coverage for this home? And then we'll find that and get the cheapest one and insure that, and we just invest the difference, because then if something happens to your home that is above that replacement cost that the cheap policy will do, you'll have the investment. Nobody does that.
But we know you're going to die. We know you're going, the car of your life is going to be totaled. We know that without exception. Every single person listening, you have that knowledge in advance that you will total the car that is your life. So what do you want to have in place when that inevitably happens, whether that's tomorrow or 60 years from now? You're 44 right now.
How do you keep aging me, dude? I'm 43. Stop it.
43. You're 40 in 2025, you're turning 44.
Dude, I got so little sleep. I look 44 with these bags under my eyes, but come on, man.
All right, you're 43, and we know somehow you're going to die at 70. Somehow we know that. The insurance company knows that, and we know that. Age 70, that's when you're going home, right? You have, what is that, 27 more years? If you ask the insurance company and they had that knowledge for a 30-year term policy, what do you think it would cost?
Would be like whole life insurance rates. I don't know.
Yeah, it's just that simple. It's not a hard concept to understand.
But still, I'll just invest the difference, because then my family can keep the cash.
Oh, dude, it's frustrating. Now, one thing we talked about here, and again, this wasn't our intended episode, but the buy term and invest the difference is such bad advice that we think that it should be addressed, and we were already on it anyways. So we talk about convertible term and what that is. Now, how does that play into our strategy? Because do we put our clients into term policies?
We do. And term policies is super important. If you go back to, I don't know the episode number, but where we talk about human life value,
Number 4.
and we talk about what your income protection is worth depending on your age. It's really hard to get that full coverage value of your human life as your economic life value, I should call it, in whole life insurance. It's just too expensive for the majority of Americans for what the insurance company will write. So we can close that gap with convertible term insurance. And it's just what it sounds like. You can take that term insurance and you can convert all or some of it, or none if you want. So all, some, or none, into whole life insurance policies that we can still design for to be used as the infinite banking. So as your income rises and you have more money to purchase more insurance, you can actually take, like, so say that was $1 million convertible whole life insurance policy, you could pull $200,000 as an example. You could pull any amount up above, I think 50 is the minimum with some of the companies we write. Don't quote me on that. 50,000. I can't remember exactly, but you could pull a $200,000 death benefit away from that, pay the premium on it, and now have another $200,000 whole life insurance that we're building the cash value. We've got all the benefits. We've got the protection for the rest of our life. And the remainder, that 800,000 in the term, still covers you in the event of an early death. And so you could keep on doing that until it's all used up. It's extremely important because it's a way that we can cover our entire human life value at a price we can afford and protect our families appropriately.
Put some more specific numbers on that makes sense. I'll say my numbers. So when we did our, this is 3 years ago, I'm doing my human life value calculation. I'm looking at my Navy income. I'm looking at my remaining working years, and I'm looking at some income from this business that was just starting to get off the ground. I said about 5 million, I think, is what my human life value is. With another 3 decades of work at my current income, about 5 million is what I'm trying to insure here. So I wanted to put my premium, understanding like how the PUA is, how much I want to put in, how much base I can reliably, sustainably pay, how much PUA I want as a goal. I wrote a policy for $50,000 annual premium, 70% of that being the optional PUA component, right? That's not the purpose of the discussion today, but just know $50,000 annual premium got me $1 million death benefit as a 33-year-old. Preferred rating, $1 million death benefit off the bat. That included the term portion, that included the PUAs, that included taking dividends to PUAs. Hopefully that all makes sense by now if you're still with us. 50,000 equals $1 million death benefit, right? But if that's all I had, and I don't want to go more, that's already a ton of money for premium. I don't want to pay more than that. But if I'm worth 5 million and I just have that policy, I'm paying good premium. I'm doing my IBC. I die tomorrow and I leave my wife $1 million. Did I do right by her? Did I fulfill my moral obligation to make sure that they are left with what I would have earned, $5 million, if I leave her $1 million? No. In net worth thinking and the way that we're trained, buy term and invest the difference, $1 million is a nice little pot of money. So if I had gone that route, I would have left her $1 million term policy, and whatever my investments were at that were supposed to be off the charts, this huge pool of money by 65. I didn't make it that far, but I got her the $1 million term policy, and these investments were $200,000 or whatever.
So hold on right there. So you're at $1 million in death benefit on that 50,000. So if you think about this, you said your human life value calculation came out to about 5 million. So if we just did that ratio and solved, it says that you would need 5 times that amount to hit it in whole life insurance with PUA. So you would have needed $250,000 a year in premium to hit your human life value. But was your Navy income $250,000?
No.
You weren't even making that much, so that it would be impossible for you to buy it all in a whole life plan, and you would have nothing to live on, and you'd be taking debt to do it, which the insurance company financially would never underwrite that. But it's an impossibility, is my point.
Right. So I know I would be doing a disservice to my family if I only left them 20% of what I should bring to the table over that time period, right? I'm depriving them of my expected $5 million of earning. I would be $4 million shy with just my whole life policy. So how did I bridge that gap? If we know I would need $250,000 to do that via whole life, how do I bridge that gap?
So you would buy $4 million in convertible term. I don't know what the cost of that was. Maybe you want to share your number. I don't remember. I remember we wrote the policy, but I don't remember the cost.
It was about $1,200. And I did 2 different $2 million policies because I started out when I'll go back. I'll caveat this. When I actually started this, I was just making Navy income. And so I was not quite worth at the time. I did a $2 million convertible term policy. I probably didn't max out my human life value at the time. But once I started making income with this, I was able to show higher income on paper. I was able to show a higher human life value.
And you had a greater understanding of it.
Right. And I knew my Navy income was going to drop off soon. So while I have this kind of double dip of like remnant finance income and Navy income, I can show more on paper that I'm worth. So I increased my human life value. So I captured another $2 million of convertible term. Each of those cost me about $1,200 a year. Did they think about that? $50,000 in whole life got me $1 million death benefit. $1,200 in term got me $2 million. Why would I ever consider whole life? Term is such a better deal, right? Well, I'm praying I would be blessed if I live past these 20-year term policies. I don't want them to pay out. I don't want my wife to get that $4 million because that meant I left them and my girls early. I don't want that to happen. But I bridge that gap with convertible term. And what is the difference between the term that people talk about? What is the added benefit of this conversion that we have? So as income expands, what do I do?
Well, you have the right to purchase more whole life insurance over time.
Yeah. So I get cancer, I become an insurable. What does that mean?
You could still convert that. So it's going to keep the health rating and it's going to keep all the underwriting ratings that you received at the time you open the policy. And the awesome thing about that is you actually get to circumvent, for lack of a better word that's coming to mind, the financial underwriting portion of that down the road. So right now when you open the new policy, they would look at your income and determine whether you can pay it. When you already have it in force, you can actually open it however you want. So if you want to put a lot more of your income into it, you have that option. So you can convert as much of that as you want, when you can afford it.
My goal would be to cover that whole 5 million permanent because I want that to be there whenever I die. If I make it to 70,
and it's going to be a lot more than 5 million because when you structure these properly with a mutual company, it's going to grow. The death benefit will consistently get larger through your entire life. So you're going to exceed. Nelson always talks about that. If you build these policies structured for infinite banking and you live, in a normal lifespan, you're going to have more death benefit coverage than the insurance companies would have ever written on you at the time of your working years, because it's always going to grow. So the system continues to grow, which is awesome. So now if you can convert as much of that original 5 million as possible, it's going to be worth a lot more than $5 million. Hopefully when you're an old gray man dying.
But ideally I can convert that coverage, that 4 million. Obviously income has to expand. I have to build cash flowing into, I have to build my system and continue to increase my entrepreneurial investment in myself, in our business. And if income allows, I will then convert some of that death benefit to make it permanent, because I don't want it to just drop when I turn, 53? right? That's not too far away. That's 17 years. I don't want that to just drop right off the table just because I lived long. I want to live long. We can bridge the gap of insurability, max out that human life value. And what that frees us up to do is, if you know that number of your human life value, you don't have to chase that with the whole life policy. Your input factor in what you want to fund for a whole life policy for IBC purposes, the premium can be the input factor. Whatever amount of death benefit you get is the output factor from that amount of premium. Great, that's what it is. The rest of it will bridge the gap with convertible term. That is how we do it. That's how we create an estate and invest the difference. Because my family will get that estate no matter what, no matter when I die, whether I outlive my term policies or not, they will get that estate. So I'm creating an estate and then investing the difference. And I think that mantra serves you a lot better than buy term and invest the difference, which works for nobody. That's a terrible strategy, and nobody should do that. We can say that definitively.
Yep. All right, man. I think that's a good sum up of the whole random idea. So good rant. Good job. Go have a beer or something, man. Go chill out.
Yeah, a little too early for that right now, but I'll tie it back to, we talked about boomers in the beginning and how sensitive they are collectively, at least in the comment section. But I'll say that we had one comment from a Gen Xer that I'll highlight here, and I hope that if you've listened to us this far, you understand why this just makes us so sad. Man, it hurt to read this, and I wanted to just go in and just butt heads with this guy, get down in the mud in the comments section, even though I don't really want to. It's not worth it. But so this guy said, right after 2 solid years of campaigning from both sides, neither one even mentioned actually fixing Social Security. That's a good point. No one's going to talk about this. It's not going to get fixed. No one's going to do what needs to happen, which is just someone bite the bullet and just shut this thing down. I'm Gen X and not counting on it, and neither should you. Yep, great advice to that point. Do not plan on Social Security being there. If you get to that point and it's still there, I guess you take yours or whatever, or hopefully we can just opt out of this altogether, but whatever. Then it gets weird and sad. And he says, wife and I have been together for 20 years and decided retirement savings over having children. We'll see which pays off first. Kids are too expensive. It doesn't make sense. I don't understand it at all, but good luck to your future generations. They're going to need it. So boomers, if you don't like the fact that we talked in less than glowing terms about your generation as far as financial preparedness and what you're leaving behind, it's not just you, it's also Gen X. And deciding retirement savings over having children is so sad to me. One, you're probably not saving. You're probably investing for retirement. That's what most people do. When they call it savings, you're actually investing. You're not saving for retirement, very likely. You're speculating, investing, and hoping the market performs. But a comfortable period of planned idleness after a working career, funded by the returns of something you don't control, i.e. the market, that's deciding on retirement savings. That decision over having children, you can't do both. It's just...
Well, to me, it's not even that. There probably are some valid reasons for some people to not have children, but simply to save for retirement is among the worst I've ever heard. Maybe some people is I hate kids. I'm selfish. And I know that about myself. And I really probably would be a horrible parent. And I don't want to have kids because I don't see the value of doing that. And it's just yeah, cool. Your kids probably would not benefit from you spreading your seed. I'm with you on that. But the actual reason for this is so that I could save for retirement. And, assuming that the historical narratives are all correct, which they're not, that we've learned, but all of your ancestors survived pestilence, war, disease, famine. They lived through these hard periods of times that we always talk about through history, and that came all the way to you. They had, some of them probably lived in some of the worst conditions. Some of them probably lived in some mining community where they could barely afford to rub 2 nickels together and died of black lung at some point. That's your great great grandfather, and they lived through this after coming across with no education. They couldn't read, write. They survived to a point that they got to you and you were screw the bloodline, man. I want to have some more money and go on a cruise. What a middle finger to your ancestors.
Yeah, it's sad. It makes me angry, but it's also just sad. I mean, you're just a pampered dandy that you need to have this luxurious retirement over having children. Where at what point does just sitting on the beach or playing golf not fulfill? And how valuable is it? I mean, like I said, my in-laws are in town right now, and they're exhausted I know they are. When my parents come, I know they're exhausted spending time with a 3-year-old and a 8-month-old. I know it is exhausting, yes, but the joy and the fulfillment from having those kids in their lives is palpable. Like sitting in a retirement community, like, what are you going to do all day?
If right now, like, like God forbid, but if right now, like there was some kind of tyrant that came along and was just like, we're either taking your kids or absolutely everything you own except the clothes on your back, which one would you choose?
I mean, yeah, take it all.
Yeah, dude, you could have my net worth. It's not worth anything, man. It's not worth anything compared to that. Like, what is more valuable than your children? It's just such a bizarre line of thinking.
Or like, you could never golf again if you want to keep your kids. Okay. You will never have like a retirement period. You're going to work until you die. Okay, cool. I'll do it.
Yeah. Hey, no more. You can't go to the beach anymore. You can't go on vacation and cruises anymore. Like, all right.
Yeah. And so then the next line, we'll see which pays off first between retirement savings and having kids. Like, that doesn't even really make sense.
That doesn't make sense. I couldn't even respond to that. I was like, I don't even understand the statement.
I guess that's a subjective thing. But if I'm saying that my entire net worth, my entire cash flow, all my rental properties, my IBC policies, everything we talk about, it would be gone in an instant to keep my daughters. Like, that's not, and it's not a hard question, obviously. Like, my daughters have already paid off. If that doesn't make sense, but like in terms of fulfillment and which I would prefer, it doesn't really make sense. And then the next thing it says kids are too expensive. Well, I mean, I've never been motivated to work harder than I am now that I no longer have the Navy income and the complacency of having that safety net. Now it's like this business that we're doing is what I'm providing with. And so I've never been more motivated to work. And I, in 2024 was the most money I've ever made in my life, incidentally. And so like, I don't know. It's just good luck to your future generations. They're going to need it. Well, thanks for the luck. I mean, I would love some luck too, but even if they get no luck, they're going to get hopefully decades with me teaching them, guiding them, teaching them to be wise stewards of money. And if not, they're at least going to get a monster pile of cash, tax-free income. I mean, from my policies, but like that's secondary. It's just the time with them. It's a sad way of thinking, man. And yeah,
I think I talked about it on a previous episode, and so I'm not going to tell the in-depth story, but it was one of those conversations that I sat in just listening to. I was 16 years old. My dad's friend from high school was visiting from California, and I just always remember this conversation. So they were in their late 40s at the time, and he'd never had children, and he had like a moment of reflection as I was sitting there chatting with him a little bit and around, and my dad was talking about all the stuff me and my brother were doing, and he was just like, my biggest regret is not having kids, because he at that point had been divorced, and I think he's remarried since, but it was just like, he's at a place where like he doesn't have that opportunity anymore in his late 40s and single. And it was just like my biggest regret was not doing this, because he wanted to live like an exciting lifestyle, be able to go out and do dancing and all the stuff that he was into with his wife. This guy appeared in movies because he was such a good dancer. It was super cool stuff, but they were into, like, him and his wife were into that sort of thing. And what's wild is like this dude, he was pretty cool. He was like a Golden Glove boxer. It was a weird thing of all the stuff he was into, but like him and his wife wanted to live like just a lifestyle for themselves. And then that was a big, massive place of regret. And I remember at 16 thinking about that, like that conversation hit me pretty hard. Like all the cool stories, he was like the cool friend, who did all this cool stuff. And it was just like, but all he really wanted was like our middle-class lifestyle where we didn't even have the money to go on like lavish vacations. You know what I mean? We drove to the beach because he would have rather had a bloodline.
the rest of his peer group that had kids, maybe in your 30s, you feel like you're crushing it because your friends are home on a Friday night. They're, putting kids in bed at 7 p.m. They're not doing all this traveling. You're all over the world and they're looking at your pictures and saying, oh man, like you're in Bali right now. And, we're just changing diapers, like I could see in your 20s and 30s when you're the friend that's doing that. Yeah, that does seem really cool. Like my wife and I traveled a ton before we had kids. We still try to, but like, we're not doing Thailand on New Year's Eve again for anytime soon, right? We're not traveling all over Japan. And so like, yeah, I do miss that. And I have friends who don't have kids and they are doing that stuff still. And it's cool to see the pictures and man, like, oh, what we would give if we could just get a week to like go and do some of these adventures. That's awesome. I get that. But at 40, is that as cool? No, not really. But when I'm 50, like, do I get jealous seeing like a 60-year-old taking pictures in Scotland? I'm like, oh, that's cool. Whatever. Like you traveling. But it's not like the same as, I don't know, like the appeal of that just fades over time. It has to, because it's just self-indulgence. And of course we like experiences, but it's not what life is about. It's like I don't know. It's just weird. So he said, good luck to your future generations and thanks that they're going to have great lives. And it's going to be awesome to be a part of it and watch them grow. And the joy from that is immeasurable and trumps everything we ever talk about on this podcast. I wrote an article called The Waiting List on our blog, if you remnantfinance.com/blog, urging husbands in particular that, if their wives are ready for kids and they're not, it's basically like, here's your list of reasons why you're waiting, hence the title, The Waiting List. And here's why every one of those reasons that you would cite right now is actually an argument for having kids now. And so that's the premise of the article. It couldn't be more opposite than this comment here. But anyways, just wanted to end that on, it's not just the boomers that are thinking like this, but as a group, they're definitely great for the algorithm because they come out of the woodwork to comment.
There's a lot of people in society thinking that way. And so all I'll say is, especially, well, first, if you're not a Christian, you should explore that before you even explore IBC. Give your heart to Jesus, and then look at the biblical command in Genesis 1:28 to be fruitful and multiply and have dominion, to sum it up. So get out there and do that, man. Make babies, make lots of them, and expand our faith and expand productivity and expand your bloodline and your nation.
Yeah, absolutely.
All right, brother. Amen.
That was good. All right. See you, man.
Talk to you later.